U.S. cannabis cultivation and retail companies have enjoyed rapidly expanding valuation metrics since the beginning of 2021. We're going to use Viridian Capital Advisors Deal Tracker to dive into it. Welcome back to the Talking Hedge. I'm Josh Kincaid, Capital Markets Analyst and host of your Cannabis Business Podcast. So we're looking at the enterprise resource value estimates for cultivation and retail sectors with more than 500 million of market cap versus the same measure with less than 500 million. So the gap between the two was as low as 4.2 multiple points at the end of September, but has widened to a peak of 16.7 currently. So in other words, the valuation for companies with a lot of money on hand was only 4.2 multiple points higher than companies that had less than $500 million in market cap. Whereas now that's kind of spread quite a bit. So first mover advantages is what I'm assuming that's all about. When you get money, you can expand, scale, and move beyond. So what you're seeing basically is another 4x multiple of that separation between companies that have money and companies that don't. And you're seeing the valuations now widening more in favor of companies that have gone out to get the money. So that's my assumption. Let's find out what Viridian thinks. They also think that there's a number of plausible reasons for the widening. They assume that the stocks of the larger companies, they're more liquid, therefore are more attractive to incoming institutional investors. A huge part of that is why I don't deal with penny stocks. There's not enough volume. So if you don't have enough volume, it's easy to push those stock prices up and then watch that crash. So I stick away from anything that has really low volume on that. Another reason is that larger companies see more likely uplisting candidates upon the federal legalization. So the companies that do have money, they're going public and then they're getting speculated. I mean, it's kind of they're there and their first mover advantages and able to be on the public markets and taking advantage of federal legalization hype. It's going to happen, but going up for no reason other than news is not investing. So larger companies are also more developed, more profitable, and generally safer, maybe. Again, first mover advantages, it's bigger you are, the less likely you are to fail, which is sad. Too big to fail is kind of a thing. All right, we're going to leave that there. Keep this nice, short, and sweet. We're going to roll this one up. I'm Josh Kincaid. This is The Talking Hedge. Don't forget to like, share, and subscribe, or don't, and I'm out. Don't forget to smash that like button on your way out and check out these other videos that we've got.